Okay, let's continue. Okay, we start from where we left. So just quick recap, we talked, chapter 19 is on pension and other post employment benefits. So there are generally two types of such benefits: defined contribution versus defined benefit. Defined contribution is pretty straightforward, and we focus on the complexity of defined benefits, pension. And so we talked about now what's on the financial statements are actually quite limited. We report pension expense on the income statement, and we report net pension assets or pension liability. So what goes into calculating net pension assets or net pension benefit liability is the plan asset and the defined benefit obligation. Neither one will be on the balance sheet per se. They are memo accounts. They will be reported in a footnote. So we do keep tracking those two items, plan assets and defined benefit obligation. However, okay, so now we can combine all, keep tracking all the events and the factors that affect both the ledger accounts and the memo accounts, combine them all in one worksheet. Okay, so we can accumulate the effects of all events and lay out the ground to prepare journal entries and to what's reported in a financial state. So yes, so that's the worksheet and a comprehensive example. Okay, so just some preliminary on the worksheet. So the pension worksheet is used to accumulate information needed for journal entries. They keep track of all the relevant changes on the components on both the ledger accounts and memo accounts. So the ledger accounts, the worksheet has two sections, the ledger account sections and the memo account sections. So the ledger account part has net defined benefit liability or asset. So that's on the balance sheet. Pension expense, that's on the income statement. And if company follows IFRS, there's also a other comprehensive income for remeasurement gains and losses. We will review all that in a minute. And then obviously cash will be used because when the contribution is made, the cash account is affected. When the benefit is paid, the cash account is not affected. So the payment of benefit is not a company's cash flow, right? It's out of the plan asset, out of the pension fund. But the contribution made to the plan assets is company's cash flow. But so we put a cash there as well. The off-balance sheet memo accounts, there are two, plan assets and the defined benefit obligation, assets liability, okay? So this is our illustration problem. There's more information given than we need. So we have a look at here. So we start out with plan assets and defined benefit obligation. So in the first year of our example, 2019, both plan assets and the defined benefit obligation is 100,000. So that means what's on the balance sheet? Did you say nothing? Both plan assets and the defined benefit obligation are 100,000. They are the same. So what's the difference? Zero. So nothing on the balance sheet, right? It's perfectly funded. And then, so these are the terms we talked about the last class, that current service cost, that's the benefit earned as a result of the service provided in the current year. Interest or discount rate, I think it should like, so this one, 10% is for both interest accrued on defined benefit obligation and the expected return to be included in pension cost, right? So this right now, currently, since the last change, I think about 3-4 years ago, I lost track, could be 5-6 years ago. Time goes so fast. So since the last change, the rate you use to calculate the accrued interest on defined benefit obligation and expected return on plan asset has to be the same. So we only have one rate now. And that's why, because it's a one rate, sometimes they call it net interest. The liability subtract assets is the net obligation, and that's net interest. So that's 10% for all 3 years. And remember, this is the rate for interest. This is also the rate for expected return. And we have a past service benefits only in 1 year. That's 2020. And the details we need to note is here is that this past service benefit granted January 1st, 2020. So what's the difference if it is granted at December 31st, 2020? Oh, does it matter? It specifically said that this past service cost was granted on the January 1st, 2020. When the past service cost is granted, it will be added to defined benefit obligation. Right now, the company has more obligation. So if it's added onto the defined benefit obligation on January 1st, that means the interest of the current year will be accrued on this amount as well, right? Whereas if this past service cost, if the amendment happens at the end of the year, there will be no time to accrue interest on this amount yet. Does that make sense? Yeah, so the time matters. There'll be 1 more year interest on this amount, which is the current year. If it's granted at the beginning, that will be 1 year interest we need to recognize. If it's granted at the end of the year, then, you know, we'll start accruing interest next year. Okay. Actual earning on plan assets. So this actual earning may, as we say, actual earning fluctuate. You have, you know, some good years, some bad years, because expected return by definition is the average long-term return. So it should be more stable, but actual return will, you know, could fluctuate. So it will be less stable. Employer contribution. So this will be the cash, you know, this will be the operating cash outflow. Okay. Now, as we mentioned, contributory plan, in addition to employer's contribution, employee will have to match, like usually less than, for every $1 employer contribute, employee will match, most times less than $1, sometimes it's more, depends. So that is not a company's transaction, right? That's not a company's money, so company does not require, you know, like, you know, that's employee decide to contribute. That's fine. That's would be that part of the funds in the pension would not be the company's plan assets, right? Because the company did not contribute to that part. So we only record employer's contribution. Benefit to paid to retirees by trustee for the year. So that is going to be reducing the defined benefit obligation and the plan assets, but does not require cash payment made by the company. Okay. And actuarial loss due to change in actuarial assumptions. This one, only 2021 has it. Now, these were the courtesy items, plan assets at the end of the year, defined benefit obligation of the year, surplus deficit, because we're supposed to be able to determine it, right? So these are courtesy items kind of thing. One more details. So employer contribution for the year. Okay, there's a note here says on 2019 and the 2020 end of the year, and 2021 mid-year. So the contribution, similar to the past service cost, if you put the money into the funds at the end of the year, there would be no earnings, no returns on that amount this year. Hasn't got the time to earn anything. However, it's mid of year, so actually when you say mid of year, it will be evenly spread, will be the same, right? Then that contribution would have time to earn some returns, right? Not from the start, because you don't make all the contribution from day one. If you make it evenly throughout the year, or that's pretty much the same effect made it in mid-year, then you should account half year's return on those amounts. Does that make sense? Yeah, so those details. Okay, so that's start first year. Now for 2019 and 2020, first 2 years, the worksheet and the journal entries are no different between IFRS and ASPE, because there is no remeasurement gain losses. So first 2 years, the same worksheet would suffice for both sets of gaps. For the third year, we need to have two different worksheets, because the IFRS and ASPE would have difference. Okay, so the first year is very simple. Okay, we start with the beginning balance here. There's nothing on the balance sheet. There should not be anything on the pension expense, because it's temporary account, right? Shouldn't the balance will be closed off, so that's okay. But there's nothing on the balance sheet either, because it's perfectly funded. Assets and liability offset each other completely. However, there are amounts in the footnote accounts, the memo accounts, because we do have plan assets of 100,000 and we have defined benefit obligation of 100,000. So if you note on this worksheet, all the numbers has a kind of a qualification, whether it's a debit amount or it's a credit amount, because we have different accounts combined in one. Okay. And so they, like I say, liability would have a credit balance and asset would have debit balance. And so we use that to differentiate. That's about the accounting, right? You have left and right, debit and credit. So like there are lots of offsets, and we differentiate that with the debit credit at the end of the numbers. Okay. Each items. So this is each items would affect these accounts in such a way that is as if there is a quasi journal entry, because it doesn't matter where the account is. Eventually, your balance sheet has to balance. Total debit and total credit has to be the same, right? So that relationship will maintain throughout. Doesn't matter where the number shows. So therefore, if you kind of think in your head, each entry, if you just put it in one column, you know it's not correct, right? Because if you just put it in one place with nothing offset, just debit, no credit, or just credit, no debit, you're going to upset your balance in the balance sheet. So you can, but these are not real journal entry. Okay, the real journal entry is the bottom part, but when we, so these items labeled A, B, C, D, those are just the lay out the effect of different factors, okay, or the changes. And the effect will occur in such a way that maintains the balance. So there should be a debit, there should be a credit. There should be a balance, there's a debit, there should be a credit. Okay, if you note, when we do that, we do not change this account. So for A, B, C, D items, none of that affect this account. It's not, it doesn't affect the account. It's instead any impact on this net defined benefit liability or asset will be spelled out in these defined benefit obligation or plan asset account, right? And it's like, you know, the retained earnings is affected by revenue and expense. But when we record revenues earned, expense incurred, we do not use retained earning account. We use revenue expense account. But at the end of the accounting period, all that impact will be updated into retained earnings as a closing entry. So it's the same thing. So all these A, B, C, D, when we put numbers here, it actually changes net defined benefit obligation, liability or asset. But that effect will be updated here when we prepare real journal entries, right? So the first one is a service cost incurred during the year. So that will increase the defined benefit obligation because that's benefit earned by employee, and then that also increase the expense. Remember, we said the items affect expense will be all the items affect PA and the DBO, except benefit paid. All the factors, right? So the first one increase this. The second one, no, benefit, yeah. The second one is net interest and the finance cost. We got a 0. It's just coincidence because the beginning balance of both are the same. So 10% of 100,000 plan asset give us 10,000 expected return. 10% on 100,000 defined benefit obligation give us 10,000 interest. And the net is 0. Okay, so this one, there's a 0 here, but we debit defined plan assets by 10,000 and we credit defined benefit obligation by 10,000. Does that make sense? Yeah, because there is an interest on DBO and there is a return on plan assets, but the amount are the same. So the net interest included in the pension expense is 0. The contribution only increase plan assets, does not affect defined benefit obligation. So the quasi journal entry will be the company pays cash, that's credited cash, and the plan asset increased by the new contribution, that's debit to asset to increase it. Right? It looks like journal entry. And then benefit paid, it does not affect any of the ledger account, but it will reduce the defined benefit obligation, just like when you pay back loans, your loan balance decrease. So it's a debit. And you pay out of the plan asset. So like any payment that assets decrease when the payment is made. So that's all that happened in the first year, 2019. That's all that happened in the first year. So at the end of the year, so then okay, so from here on, these are real journal entries. Okay, the one above, they're not the journal entries. We don't put them in our journals. They're just kind of we are just accumulating. I want to say recording, but it's not recording. We're just writing down the impact of these various items, right? We do not actually record them in journals. And after we writing those down, we know what the summary impact these items has on the account. Okay, so now this item will show the total pension expense. Okay, so we will have to debit a pension expense and credit a liability. So these only, when these journal entries are recorded, only ledger account will be affected, right? So we debit pension expense, credit net defined benefit liability or asset, and then the contribution, that's also a transaction, because whenever you receive cash, you'll pay cash, that's a real transaction. So we credit cash and the debit defined benefit obligation. Okay, so those are the two transactions we have for this year. And so this account started with a 0 with a credit of 9,000 and a debit of 8,000. Now we have a balance. So the balance sheet at the end of 2019 would have a net defined benefit and liability of 1,000. Also, when you tally up all the changes in defined benefit obligation and the plan assets, you will have a updated balances of these two accounts at the end of the year. And the difference between these two accounts happens to be $1,000. That's our deficit. At the end of the year, defined benefit obligation is 1,000 more than the plan asset. So we have a deficit. And that difference happens to reflect, has to be reflect on the balance sheet. And anything shows in the financial statements, you can't just put it on the financial statements, right? It has to be the natural result of your entries. And so we did. By recording pension expense, by recording contribution, we did enter this $1,000 in here. And that reflect a deficit of the plan. So this worksheet, you see how neat it is? You know, you just put in everything, focus each items. And by the end of that, when you tally up everything you entered, you get everything you need. You get everything you need. So for pension, on the income statement, you need pension expense. When you make a contribution that affect your cash, that should be reflected. On the balance sheet, that should be net defined benefit liability or asset, that's there. And these two, these are actually has all the contents of what you need in the two continuity tables that you need to include in the footnote. One is continuity table for defined benefit obligation. You actually need to show these details. That is like what changed your defined benefit obligation. What's the beginning balance and what are the changes and what's the ending balance? To explain the changes. That's why it's called a continuity table, continued changes, right? You also need a continuity table for plan assets. So they're all here. They're all here. Okay, so that's first year. So these are the journal entries we just talked about. That you actually have to do a journal entry and it will be posted to the ledger. It will be reflected in your financial statements. And so now let's look at the next year. Next year, this time we have opening balance now, right? No, nothing in the pension expense. You will never have an opening balance for pension expense because it's temporary account. Whatever it was in there from the last year would have been closed. Okay, so there's nothing there. There will be cash, but the cash affects so many things, so we just don't worry about that. We just focus on the impact. But now we have a liability of $1,000. That's the net defined benefit liability. Okay, that tells us the plans. Usually there are many plans like St. Mary's. If you go on the website, so everybody worked in St. Mary's, but there are different unions, like unions for faculty and the librarian full-time, and unions for part-time faculty, and unions for staff. I think there's different groups in staff as well. I think there's a group for engineers. So they have different plans in the but for the company's perspective, they just put everything together, right? So the plans are underfunded. There is a deficit of $1,000. So this is the year there's a past service cost, right? And the past service cost was granted. The amendment happened at the beginning of the year. So we put that in first so that will facilitate our computation. So past service cost, remember, like past service cost, because it's already happened and there's no offsetting factor in the future. So it's unlike actual gain losses. They could reverse because in some years, you know, like it's long term and the changes can go both directions. So that's why that for under IFRS that goes into other comprehensive income. But past service cost, there is no such reversing potential, right? It's service already provided, benefits already earned. You didn't grant those benefits in the past. Now you amend your plans and you grant those benefits, and then you grant those benefits. You can't take it back in the future, okay? So those past service costs are recognized in the expense immediately. So with in debit, these are not real journal entry. I want to keep saying, but think them as journal entry would help you to kind of to fill in on this worksheet, right? Because it in a way it has the similar impact. So we increase pension expense, and the increase in expense is debit. It will increase defined benefit obligation, that's liability. Increasing liability is credit. So that's a quasi-journal entry. And current service cost, similar, 9,500 debit to pension expense and credit to defined benefit obligation. Net interest, okay, so net interest is calculated. You can calculate in two ways. You can either calculate net benefit obligation, that's DBO minus PA, and times 10%. Okay, or you can calculate interest on defined benefit obligation and expected return on plan asset. The difference of the two is net interest. And I think the second one is better because you still have to enter expected return and interest in the memo accounts, right? So that's kind of help you. So defined benefit obligation, the interest on that is calculated as 10% of the beginning balance plus the past service cost. As we said, we add this one here, because the amendment is at the beginning of the year. Okay, so the interest is 19,200, and expected return is just the beginning balance at 10%. It's 11,100. The difference between these two is 8,100. So the journal entry would include two debits, because we debit planning assets and we also debit pension expense. The total debit is same as the credit to defined benefit obligation. Okay. So another way, after you increase plan assets, increase defined benefit obligation, there's a difference. The difference goes into pension expense. Okay, so that's that. And the contribution, that's a higher because there's a past service cost. So, you know, usually you have to increase your contribution. So the deficit will not become too big, right? Because there's a funding requirement. You cannot be too underfunded. Okay, so there's a 20,000 this year. So that will reduce cash credit, increase plan assets debit. And the benefit paid has nothing to do with ledger accounts, but decrease plan assets credit and decrease benefit obligation debit. Okay. Okay. So so again, at this point, like we have had everything calculated. That what comes, I really should change the color to emphasize the different nature of these amount entered. Okay, so so that items E to I, those are not real journal entry. We're just laying out the impact of those items. But what is down here is a essentially summary of the journal entry. So when you sum up all your expenses, all the items that increase expenses, that will be your total pension expense, and that needs to be recorded. The journal entry will be debit pension expense, credit net defined benefit liability. And cash contribution, that's a real transaction, and we need to record that. So we need to credit cash and debit defined benefit or liability. Okay, so those are. And then so this account changed by these two entries from 1,000 credit at the beginning with the 97,600 credit and 20,000 debit. We have a balance of 78,600 credit. Again, this is a deficit, bigger deficit than before. And then if you tally up the changes in defined benefit obligation, which is the continuity table will show that, then you will have a total defined benefit obligation of 212,700 at the end of the year. And the plan assets changed from 111,000 to 134,100. And the difference between these two, has to be the deficit that's going to be shown on the, see, the difference of these two. So bad. The difference of these two happens to be this amount. Okay. All right. And so the journal entry will look like that. It's just when you write it out, debit pension expense, 97,600, credit defined benefit, net defined benefit liability, 97,600, and the debit net defined benefit liability 20,000 with a contribution and credit cash contribution. Okay, so next year we need to separate. SB is different from IFRS, so we start with the SB, no other comprehensive income. Okay, so this year we carry a opening balance on the balance sheet 78,600. That's a net liability. That's the difference between a DBO of 212,700 and the PA of 134,100. And so the service cost is debit to expense and credit to DBO. Net interest is the difference between, so the DBO has 10% of opening balance accrued as interest, 21,270. But this is the year we assume the contribution was made in the middle of the year. So this year, the expected return down here is calculated differently from previous years. Okay, the way the previous year's expected return was computed implied that the contribution was made at the end of the year. This year was in middle of the year. So in addition to beginning balance, we need to add the contribution from the middle of the year. So it's earns return for half of the year. So the return is 14,610. So the difference between interest expense is higher than the expected return. So the net of the two, 6,660 is added to the interest. So the journal entry is added to pension expense. I think net interest is added to pension expense. So the journal entry is debit pension expense 6,660. Debit plan assets 14,610, and credit defined benefit obligation 21,270. Okay. This is also the year we have a remeasurement loss on plan assets. So up to this now, the expected return on plan assets is the same as the actual return, right? But this year is different. So actual return is like when you invest your plan assets, whatever you earned is whatever they will affect plan assets. But only the expected portion goes into pension expense under IFRS. But we're not talking about IFRS, we're talking about SB, right? So the difference between the actual return is 12,000. The expected return on plan assets is 14,610. Okay, so we add 14,610 in here, but that plan assets did not earn that amount this year. So the difference is 2,610 needs to be adjusted. In this time, it's a credit because the expected return is higher than the actual return. So we actually have a remeasurement loss. Okay, so this credit, the net of these two would ensure that, so net of these two would ensure the amount included in the plan asset I think I got a shape on that. I could do something. Yeah, okay, I got it back. Okay, so these two, the net is 12,000. That's the actual return, right? And then that's what actual increase in the plan asset. So we need to recognize that. And so this difference between actual and the expected return is called the remeasurement loss, or sometimes can be gain, this time is loss. And so under SBs, there's no other comprehensive income. So this remeasurement loss goes to pension expense anyways. The contribution, same as before, debit, plan assets, credit cash, and the benefit paid, debit, defined benefit obligation, and credit plan assets. And then we have actuarial loss. Okay, actuarial loss. So that's basically after revising the assumptions, and mostly these are assumptions to determine defined benefit obligation, such as inflation rate, discount rate, expected life expectancy, and all that. So they revised those assumptions, and that changes the amount of defined benefit obligation. So this time it tells you, as a result of that, the defined benefit obligation increased by 28,530. Okay, so that's the change. And so that would, we will have to add that to defined benefit obligation, and that under IFRS will go into other comprehensive income, but there's no other comprehensive income in SB, so that goes into pension expense as well. Okay, so that's a new item. And when that's all done, so the items after all would be the journal entry. So add all the expense up, 50,800, that needs to be recorded. That cash contribution needs to be recorded. Okay, so that's what would be the journal entry. Okay, so as a result of that, okay, as a result of that, I think this is it. As a result of that, the defined benefit obligation would have a credit balance of $105,400. Okay, so the deficit just keeps growing. And that should reflect the difference between DBO and the PA. Okay, the way it's laid out, this will definitely be the case. Okay. So that's just to show the last one. So if this company follows IFRS, things will be slightly different. There will be one more column in the worksheet, other comprehensive income. Okay, and so the two remeasurement loss. One is related to the difference between actual and expected return. The other one related to actuarial loss will be instead of included in the pension expense, will be included in other comprehensive income. So that's all the difference. There's no difference in net defined benefit liability. Okay, there's no difference in plan assets or DBO. There's no difference, but only two of the components will not be included in pension expense. That's all. So that will affect our journal entry, the first one, right? Even though the total increase in the defined benefit liability net is the same. Oh, that's not right. This is should it be 20 46. Yeah, that no, 66. That's Oh, yes, that's 31. 19,900. Let me, that do add up here. Let's see what shows here. 20. Oh, that didn't show total here. So that's no excuse, but now we get it correct. Yeah. So the total amount, 50,800 will be debited into two accounts. Pension expense 19,660, thank you, and other comprehensive income 31,140. Okay, the rest are the same. So naturally, antithetical situation, which set of gap will give you more volatile net income? Identical situation, if you report same company, same transactions, if you report under ASPE, your income, at least before tax, will be more volatile, right? When under IFRS, it will be less volatile. Now, a word on the homework. The homework, just read very carefully. I think the remeasurement, the actuarial loss is given in a different format, right? So here they tell you what actuarial loss is, and in assignment, so it's more realistic. It's just actuarial reassessment give you a what the liability should be, okay? Because that's how they just estimate future benefit, and you discount those benefits to the present value. That's what you be DBO, right? So the actuarial revision give you a new DBO. They not tell you whether there's an actual gain or actual loss and what is the math. So we need to calculate what the actual gain loss is by computing the difference between what the balance the actuaries tell you to be and what the balance you calculate, right? After factoring all the service costs, interest, and all that, right? So what should it be? The difference should be the actual gain loss. So that's just that. I think, yeah, and also like it's similar to this transaction, pay attention to when the past service cost is granted, right? Just like this one, if it's granted at the end of the year, then there will be no interest accrued in that year. If it's granted at the beginning of the year, then you have a full year interest accrued on that amount. If somewhere in the middle, that means you need to accrue partial year interest. So that's that. Same thing with the contribution. Okay. Couple more things. So we pretty much finished a couple more things. Other post-employment benefit plans. So we focus on the pension, but that's the not only thing, right? So in addition to pension plans, companies can provide their employees with the other post-employment benefit, such as healthcare, prescription drugs, life insurance, long-term disability, dental and eye care, and so on and so forth, right? Benefit. Unlike similar like a pension plan, it's the same thing. You know, these benefits are earned while employees were employed, and the benefit will be received when the employee retires. So that's the same. So the accounting should be the same. There is one notable difference. That is, there is no regulatory requirement to fund these benefits. So like if you look at the footnote of the company, which if I have time, I will go to, because I have one already on the Brightspace, that for these other post-employment benefit, there is no plan assets because there's no requirement to fund them, and usually they're not funded. Okay, so they just pays as the benefit needs to be paid. So that's one difference. That's one. Another one is this review topic. We didn't have a review topic this time at the beginning, right? So I kind of think what I wanted to talk about probably is better left after we cover the chapter. That's the related assets liability. The way the pension plan went through changes, right? And it did not resolve all the controversy. One of the controversy is this netting of assets and liability. Okay, and so plan assets PA and DBO are related, but they are not the only items that's related. Okay, and so this netting is not done pretty much anywhere else. Okay, so one of the very similar example would be the sinking fund. So you have a loan that you borrow the money, and towards the end, when the loan approaching its retirement, the sinking fund, you have to put the money aside to pay that loan. You're required, and the money you put aside to pay that loan is earmarked for the loan payment. You cannot use for anything else. And really, what is the difference between that and you have pension liabilities and you have plan assets? Plan assets is earmarked to pay that obligation, right? However, that sinking funds, you do not net it. The cash is including cash in your asset. The loan that's going to be paid off is in your liability. Okay, so is plan asset an asset? And who owns that plan asset? Is defined benefit obligation or liability? Well, many people believe they are real assets, real liability. Okay, but they're not on the balance sheet. So that's where the controversy. So there's a kind of some people strongly believe they should be on the balance sheet, just like, say sinking fund loan and the funds that set aside to pay that. However, in the end, it was not. And so why does it matter, you ask? Well, think about the ratios, right? If you only have the net liability on that, your leverage will be less than if you have the total liability there and total assets on the other side. So it does matter. Some analysts actually would, before they analyze the company, they would put those two on. They would put the plan asset, including assets, defined benefit obligation on the balance sheet to replace that net amount. Okay, so I mean, as we said, I think the more probably we know about accounting, the more we realize what a mess we have here in a way, right? It's like you have talking about the apples and oranges. You have a fair value, you have a cost, you have discounted future cash flow. So the older way to measure, we're not talking about the same measures. And now we have some items that are included in absolute amount on both sides. Some are netted. Yeah, so I guess the real life is, the real world is messy. And so I guess we should not be kind of disappointed by the way it's messy, but more you know it, the less likely you will be led into some kind of misunderstanding, right? So that's that. I do want to show you a continuity table because you will be required to prepare it. So I will show it in the example I posted. Yes, thank you, Aruni there. I think that when I calculate the amount run. So let me show that. I believe it's. Oh, that's not what I want. Okay, so let me share with the folks online. So this is Empire Incorporated, the Sobeys parent company, right? So if you look at the balance sheet, let me see. They have, oh no, on this side. So they actually have this employee future benefits, that this is the net defined benefit liability of $261 million, $0.1 million. So that's that. And let me see. We do not have, I'm pretty sure, there is no pension expense in here. Doesn't mean there's no pension expense. Pension expense is operating expense. It will be included in this a selling and administrative expense. Okay, it will be included in there. Oh, where's the footnote? Okay, I cut out the footnote. You know, luckily we're doing this, so that's just found it on that right away. Empire Incorporated. Doesn't matter which year, does it? So we'll look at the most recent here. Here, we did get it. So let me share this, new one. Okay. So this is the annual report. We have to find the footnote. Footnote what? Footnote number 18. So it's a different year. This year is number 18. So let's go to footnote number 18. Okay, here it is. Employee future benefit. It's quite a long note because they tell you what kind of a pension plan they have. Defined benefit would have more disclosure, but they also have defined contribution plan. That just nothing in the footnote. And they have all the risks and assumptions. But what I want to show you is these continuity table. Okay, so but about the defined benefit obligation. Okay, so they have comparative 2 years, but they also separate pension benefit plans and other benefit plans. So the continuity table starts with the beginning balance, the current service cost, the interest cost, benefit paid. There's a past service cost in 19, but not 20. And there are curtailment settlement that has to do with sometimes there are changes in plans. Curtailment means some people just kind of wind their plan up. And then they have remeasurement, which is actuarial loss for both years. Right. So these are all the changes to defined benefit obligation. So that's the continuity table we need to do. The continuity table for other benefit plans are similar. And then they have plan assets. Okay. For pension, start with the beginning balance, add changes, interest earned, remeasurement loss. This is the difference between actual and expected returns. And then they have employer contribution benefit paid, and they have an administration cost. Okay, so that gives you balance. Look at the other benefit plan. They have none of that trouble. So the benefit paid is this amount, they contribute. So basically they pay as they go. There's no funding to those benefits. Okay, but other than that, it's the same. Okay, and they also have those two comes up to the funded status. Funded status. Okay, so they are underfunded. They have a deficit. So this amount adds to this amount is the amount in the balance sheet. Okay, in 2020, there's 190.8 million deficit for pension plans, and there's 113.3 net liability for other benefits. So that's the amount on a balance sheet. And they also have pension expense. The detail. So the amount we didn't see, it's a small, right? 7.7 for pension, 6.1 for other benefits. So it's a 13.8 million. It's not material enough to be listed separately, so it must be included in some other expense. And so this would be the changes in the other comprehensive income part, the remeasurement gain losses. So, and then there are additional, like, the discount rate used, and then they have a little bit of what if analysis. So like if the discount rate increase a little bit or decrease a little bit, these are like give you a sense of how these liability and the expense will be affected had the assumption be revised a little bit. Okay, but for the most part, the information in the footnote we can find in the worksheet, right? Like the components of defined benefit obligation, the components of plan assets, the component of pension expense, and the components of other comprehensive income. And the surplus of deficit. Okay, we have all that. We did not prepare continuity table separately, but as a part of the worksheet, it's there. In the assignment, I did ask you to prepare that. So here I showed you. Okay, so that's good. Any questions? Okay. Good. Good. Then that'll be all today. And just update, I'm more than half done with my marking. And as I promised, it will be done before this week is over. Okay. So that's good for today. See you next week. Have a good weekend.